The Federal Reserve moved to make one more interest rate cut before the end of the year. That quarter-point cut marks the third cut this year as the Fed works to fight inflation. The Fed has used high interest rates to try to slow the economy, but Americans keep spending and prices recently ticked up. The November reading of the government's Consumer Price Index showed prices up 2.7% year over year, ticking up slightly from October and further away from the Fed's target rate of 2%.
Joining me now is Metropolitan State University economics professor, Dr. Kishore Kulkarni. Thank you so much for being with us today. We appreciate it.
Thank you very much for having me,
Yeah,
Karen.
so great. We want to talk about finances here, of course. What does this mean for all of us with the Fed cutting the rate a little bit today?
Well, with that small cut of only 0.25%, it doesn't mean much. But then again, it is the third cut, so about 1% has come down in the whole year, which is kind of significant. So we have obviously anything that needs a loan and all, they are going to be easier for the consumer loan, the business loan, mortgages, the student loans, and that is probably a good news for the borrowers as such.
Yeah, let's talk a little bit about that. We know Colorado, tough market to buy a home in, but so many people want to jump into that market. Will this help with the mortgages? I mean, you're not talking about a lot, but will it make a difference?
Yes and no. I think the mortgages are not completely based upon what the Federal Reserve does. And again, as I said, it's not a very significant change in the interest rate. So the mortgages will be just a little bit cheaper, not a whole lot.
Let's talk about credit card relief. And a lot of people have credit cards or credit card debt. And those rates have certainly skyrocketed here over the last 2 years.
Correct.
Will this start to make will we start to see some of those rates come down a little bit?
Yes, I think credit card companies probably will lower the interest rate a little bit because they haven't done that for a long time. And as it is, their rates are very, very high, 16%, 17%, and they should come down a little bit, but not a lot.
Do you any idea how long does that take? Like the ripple effect, is it 3 to 6 months? Is it quicker than that, or do we even know?
Probably we don't know. I think
whatever they want.
3 to 6 months is better guess than just tomorrow or in 1 month or so.
So a little longer term effect. And of course, why do you think the Fed is penciling in only 2 more rates for next year? They're saying they're going to be a little stingy with those rate cuts. Why do you think that is?
Well, actually, there is a summary of economic projections that Federal Reserve published today as well. And that summary of economic projections tells the Fed what they are expecting for the future. And they are not expecting a whole lot better for inflation front because they're expecting inflation to probably not get as better as they are expecting. And that's why the interest rate cut is not really going to happen in 25. That's what they said. And if they really stick to that, then that is bad news. And that's why the market fell by 1,100 on Dow Jones today because investors don't really like that there won't be any change in interest rate again.
Do you think they could change their mind once we get into 2025?
I think they have changed their mind before, and economy gives them better ideas what to do in the future too. So future will decide how they do it. Right. But right now they are saying that they will not lower the interest rate as much in 2025.
All right, here's hoping that they will. All right, Dr. Kulkarni.
Thank you very much.
Thank you so much for being with us.
Yeah.
Of course, we appreciate your time.
Thank you.
All right, Karen, thank you so much.